All right, stock's pretty close to those lows. Let's bring in Joe Mazzola and Cooper Howard to continue our chat. Joe's the Director of Trading Services, and Cooper's the Director of Fixed Income Strategist at Schwab Center for Financial Research. Good afternoon, guys. Mr. Mazzola, we can't blame this on bonds today, so I guess we got to find something else.
Yeah, I mean, I think the initial reaction was, oh, it's the Fed speak, more hawkish speak. But yeah, you're exactly right, Oliver. You didn't see any spike in yields on the front or the back end of the curve, so I don't think you can blame it on that. I know your previous guest was talking about some of the more geopolitical risk in the Middle East, but then at the same time, you don't see gold rallying either. So this could be just a run-of-the-mill kind of risk-off type trade where there could be some of that technical selling. One of the things that kind of stood out as I was trying to figure out, where this is coming from. Bloomberg had a report talking about there was 80,000 S&P E-minis that were trading in every 10-minute block, really since around 2 p.m. Eastern. That's the type of trading you see at the close, Oliver. That's not stuff you normally see midday. So there was a pretty heavy rotation going on, some pretty decent selling in terms of the futures that kind of spilled over into the equity markets. And I think one of the things that we've been talking about, I know specifically Nate's been talking about this with you, is the kind of the divergence, right, between the S&P 500 and the RSI, and then specifically the NASDAQ and the RSI. And that really came to roost today. Look at the NASDAQ RSI is now sub 50 again. Okay,
exactly. That's a good point because basically, yesterday we kind of had something. There are air pockets. Yesterday we had an air pocket. Now that one got filled back up by the time the actual bell rang. Today it's not going to. But that was kind of the similar situations. We've had a few of these along the way here that have told us, we're not sprinting anymore. And, when you're sprinting, it really requires something dramatic for you to suddenly crash. More often, you kind of just slow down first. That kind of feels like what we're doing.
No, agreed. And I think if you take a step back, one of the words that I think is going to be key over the next couple of weeks is catalyst, right? What's the catalyst that is going to either push this market back towards highs, or what's the catalyst that's going to, reverse it? And, to me, it's going to be earnings. Earnings kick off in about 10 days or so, and you're going to get a little bit more information. I think two of the sectors that are really, I don't want to say at risk, but something I'm going to be really watching quite a bit is energy and materials. Banks too. Yeah, absolutely. I mean, if you look at financials, energy, materials, those are three of the strongest sectors that we've seen in terms of, their percentage of the stocks above their 50 and their 200-day moving averages, especially as of late. But with the energies and materials in particular, if you look at expectations for year-over-year earnings growth, it's actually negative, and it's become more and more negative as we've gone over the last couple months, as analysts have made their revisions downwards. You've seen those two sectors really start to kind of take off in terms of their valuations and in terms of their multiples, but at the same time, expectations for earnings are kind of reversing and becoming more negative. So those will be two that I'm really going to be watching.
That's kind of an awkward setup. Hey, crude's running though. That's going to help energy companies. Oftentimes those numbers will take a back seat if WTI is up on the day. Enough, that is. I like the point on the materials, too, because the sector is, as Lizanne was telling us this morning, like getting hot in a way you usually don't really see, so they've got a bar to live up to. All right, so Cooper, let's go to bonds now, because, again, you can't blame today's stock sell-off on bonds. Yields are down. I mean, the dollar's actually even still a little bit lower on the day. But how impressive is it to see bonds, Cooper, rally as much as they are, despite what seemed to be generally hawkish commentary today from the Fed speakers?
Yeah, I think that you hit the nail on the head when you said generally hawkish. I think that really, if you look at a lot of the Fed speakers, you can kind of pick your own poison or kind of choose your own adventure. So I was kind of joking around to some of my colleagues that it's Fed Speak Thursday, if you will. There was a series of different Fed speakers. So if you listen to Kashkari, who said that cuts are not needed if inflation doesn't slow, he was a little bit more hawkish. He leans a little bit more hawkish in general. Or potentially if you would look at somebody like Goolsbee, and they said that they need to be convinced that inflation is going to be on the path to 2%. So he was really preaching from this similar kind of story is patience and kind of what other Fed speakers have been. So I think the bond market's trying to navigate all of the different Fed speakers today and probably just threw their hands up and said, we don't know which one to pick.
Hey, I was kind of like tongue-in-cheek, but giving Goolsby a little bit of a hard time, I guess, because he's our hometown guy here. But he's been like super dovish on everything. And today he said, housing inflation actually needs to cool off a little bit more. That could be a problem. That's like the first time I've ever heard him say anything could be an issue. Cooper, am I wrong?
He generally does leave a little bit more dovish. So yes, you are. I'd have to go through a lot of the transcripts to pick it out, but I wouldn't say you're wrong, but you might be.
Kashkari, generally our hawk still out front, Cooper?
Yeah, he is generally a hawk, and he did say that if they don't see inflation slow, then cuts probably won't be needed. So I think that that's what the difficulty is. So, I mean, there's the old adage, Federal Open Mouth Committee. Whether that's right or wrong, I think that there's kind of some throwback against that or pushback against it. But I think that that's really what we're seeing. We're seeing a little bit of a mixed message today from the different Fed speakers. And I think that that's what the bond market's trying to react to. And by trying to react, they're really not reacting too much.
Yeah. All right, Joe, the last point here as we connect this all tomorrow for employment, the fact that we didn't get a rate-driven sell-off today and that selling is putting enough of a bid into bonds, I do kind of wonder if maybe we've reduced some of our interest rate-driven fear compared to the beginning of the week. I mean, it seems like tomorrow you'd have to have a real scorcher for bonds. Or, I mean, look, I guess you could take the other side, which is that they rallied today because of stocks, so maybe they're more susceptible to selling. What do you think, Joe?
Yeah, so that's kind of what I'm wondering, Oliver, is whether or not this is a flight to quality type trade that we're seeing today. Right. So yeah, I'll take a step back and kind of look at the equity markets again, because Cooper's much more knowledgeable than I am on fixed income. But when I look at just the NASDAQ in general today, nasty looking candle in terms of a bearish candle right at that 50-day moving average. So tomorrow's print, as you mentioned, it could be very telling in terms of what equities look like over the next couple of weeks.
All right. Great stuff. Thank you very much, guys. Very helpful. Cooper Howard and Joe Mazzola. Thank you, gentlemen.